Major Reliance talk about the other, and that's HDFC Bank reported a good set of numbers for the quarter gone by. Net interest income rose 2.6% sequentially, while net profit has fallen 2% in the same period. The private lender also saw some deterioration in its asset quality, with GNPA at 1.33% versus 1.24% in the previous quarter. My colleague Gaurav is standing by with more details and a breakdown of what these numbers look like. Gaurav, good morning. Take it away.
HDFC Bank came up with their Q1 numbers, which were actually in line with what the street was expecting. Because when we look at the interest income, that increased almost by 2.2% on a sequential basis, while net interest income increased almost by 2.6%. PAT saw a decline of around 2% on a sequential basis, while PPOP was down almost by 18.4%. But all this was already penciled in by the analyst if we look at the pre-quarterly updates. When we talk about the overall asset quality, there we saw a little bit of deterioration. GNPA deteriorated almost by 9 basis points, while NNPAs increased almost by 6 basis points on a quarter-on-quarter basis. But let's not forget that in this quarter, Agribic was something where the concerns were building, and this was already penciled in by the street again. When we talk about the pre-quarterly updates, we have already seen a poor set of numbers from the bank because deposits reported a muted growth, while advances shown a degrowth of around 1% on a sequential basis. But all in all, when we talk about the Q1 numbers, there we saw some kind of inline set of numbers from the bank reporting for the quarter. Lastly, let's also not forget that net interest margins came at 3.47%, which shows an uptick of around 3 basis points on a sequential basis, which is again a positive thing for the bank because street was more or less penciling in a flattish net interest margins in this quarter. So definitely watching out on how it pans out for the investors, because on the numbers front we have seen inline set of numbers, while net interest margins have actually came up at a positive surprise for investors.
Alright, thanks Gaurav for that update coming in. Let's also listen into what the management had to say about the operating expenses on the conference call as well then.
The operating expenses has to be looked at in two lights. Right? One is 166 billion rupees for the quarter, an increase of 18%. When you compare it to last year, it has a merger effect because you know that the merger happened 1st of July. So April to June of last year did not have HDFC Limited in it. So that is why year on year when you compare it is 18.2. On the same token, when you look at the expenses 18.2%, you can look at the revenues 23.4%, because that also last year April to June HDFC Limited revenues were not there. So when you look at it comparably, 23.4% in on a reported basis to reported basis, and similarly expenses 18.2 on the comparing the two quarters. However, when you look at the cost to income ratio, it's 41%. Last year same quarter it was 42.8 or something, right? A little more than 42% it was last year. So the cost to income has come down. Efficiency has improved. Now one other way I would draw your attention is also sequential, which means March to June, how did that cost to income move, or how did that cost increase or decrease? You see a decrease, exactly what you alluded to. A staff cost is down. You know that in the March quarter, we did have a one-time ex gratia provision of about 1,500 crores. If you adjust for that, that means you take that out and look at it, cost moved by about 1%.
All right, well, that was the word coming in from the management of HDFC Bank. But let's move on, also take a look at what brokerages are making of these numbers. First up, let's begin by what Jefferies has to say. They've maintained a buy rating, but gone ahead and cut the target price from 3,525 rupees earlier to 3,580 rupees. We'll just get that corrected on the plate here. Moving on, let's also talk about what the rationale behind Jefferies is. They say that the Q1 review is in line overall, but the retail has disappointed. Management is rationalizing unprofitable parts in retail with focus on margins going ahead. Jio should see strong growth on the back of the tariff hike, and outlook on O2C profitability remains subdued for calendar year 24 going ahead. So that's the word coming in from Jefferies on Reliance. Moving on, let's also take a look at what Macquarie had to say on Reliance. They've maintained a neutral, hike the target price to 27.50 from 26.30 earlier. Q1 was a material miss against estimates is what they're saying. They continue to see downside to consensus EPS, and consensus earnings updrift meets a road roadblock is what they have to say. Also, let's keep it going with more on these HDFC Bank brokerages coming in. We also have Goldman Sachs coming in. Quarter one operational beat, earnings visibility looks like it's improving. Asset quality has remained pristine. GNPA slippage ratio is better than estimate, and they expect rebound from the lows of the core PPOP and ROA in FY24. Coming back, let's also talk about Nuvama. Retail loans and higher LCAR have aided NIM expansion. The CEO has reiterated that the bank shall likely lower their LDR soon, and asset quality continues to remain strong. Coming back, I just want to quickly correct myself on what the Jefferies view is. They believe that the expansion in margins is a positive. Margins have compensated for a softer balance sheet growth. Slippages have risen largely due to seasonal NPLs, and earnings have softened due to lower NIMs. That is what Jefferies has to say on HDFC Bank. Pardon me, what I said earlier was for Reliance, and they've hiked the target price to 1890 compared to 1880 earlier. So, well, that's the view coming in for HDFC Bank across brokerages.
Well,
if you like this video, then like, share and subscribe to ET Now.